All right, guys, how are you? Give me a thumbs up if you can hear me. Okay. Can you see the screen properly? All right, cool. Let's see who we got. All right, so you guys have any questions you want to put in the chat right away? Take advantage. Drop it in the Zoom chat if you have any questions regarding the previous chapter. Before we start, just a few more minutes before we start, now's the time to ask questions. Hey Janice, how are you? So YouTube Live is working. Great. Right here we have Steven, Carlos, Susanna, welcome. We got Perla, Luz, Jane, Anthony, Riley, Gary, Geraldine, who else? Lena, Chad, Daphne, Gill, Vanessa, Nicole, I see you, Catherine, Mina, Sabrina, Brian just came in, good. All right, still missing a lot of people. All right, guys, take advantage. If you have any questions regarding the previous chapter, chapter 15, primary, secondary markets, now is the time to ask those questions. Janice, if you have any questions, you can also ask in the YouTube chat, okay? Geraldine, you're laughing too much. That means you got distractions with you. Just saying. I mean, I'm glad that you're happy and smiling and all that. That's not what I meant, you know. Mina Youssef, can you go over Fannie Mae and Ginnie Mae? Do you want to go over Freddie Mac as well, or just these two? Sure. All right. Geraldine says, my cousin came from Maryland unexpectedly. Well, then, unexpectedly, tell your cousin that for the next 3.5 hours you need to focus. Tell your cousin your instructor said so. All right, so let's go over Fannie Mae, Ginnie Mae, and Freddie Mac real quick. So there's a primary market, and I see Daphne, you're asking a question, and Perla, I see it as well. So Fannie Mae, Freddie Mac, and Ginnie Mae, they're called warehouse lending agencies. What does that mean? They buy in bulk. Okay, so think of a warehouse where you store a lot of stuff. That's what they do. They buy in bulk. They buy loans in bulk. So they'll go to Bank of America and say, Bank of America or Wells Fargo or whatever, Bank of America, hey, listen, what loans do you have? I'll buy 1 out of every 10 loans that you issued, right? So if they issued 1,000 loans for that quarter, then they buy 1,000 loans that quarter from Bank of America. Then they'll go to Chase, do the same, and so on. So warehouse lending happens in the secondary market. It's originated in the primary market with intent of selling to these bigger companies, to the warehouses. You got it? So that's what Fannie Mae, Ginnie Mae, and Freddie Mac are. They're in the back end, and that's secondary markets. So all you need to remember is, because we're selling to the secondary market, and that's the majority of our business, let's say as a lender, it's the majority of my business is to sell in the secondary market, then I'm going to look at the criteria that the secondary market is willing to purchase. All right? So that's why I gave you the examples. If I'm your investor, guys, I'm your investor. I'm solely focused on you, and you're solely focused on me. And I tell you guys, hey, I'll buy any house that's green. Remember I said that? Then how many green houses are you going to look for? As many as you can, because I'll buy any, as long as they are green. If they're not green, I'm not buying. But if they're green, I buy. So it's the same thing. So lenders, institutional lenders, they change their guidelines according to whatever the warehouses are going to buy. You got it? So that's pretty much what Fannie Mae, Ginnie Mae, and Freddie Mac do in the secondary market. Are these the only participants in the secondary markets? No. These are the biggest ones. Then there's hedge funds or trust funds. Let's say all of us get together and we pull $100 million, let's say, right? We pull $100 million and we reach out to these banks and say, hey, if you have notes, we're going to buy your notes, your promissory notes. So that's the loans that were issued. Can we do it? The answer is yes. If we do that, we are in the secondary market because it's after the loan was originated. You got it? Can Chase buy from Bank of America? Can Bank of America buy from Wells Fargo? And so on. The key word here is I'm buying something after it was originated. It doesn't matter who it is. If they're buying an originated loan, at this point in this transaction, in this purchase, they're operating in the secondary market. That's all it is. Okay? So Fannie Mae, Ginnie Mae, and Freddie Mac are the largest purchasers of notes, right, or loans, right? But then there's smaller companies like Bank of America, Wells Fargo, and even us, if we form a company, that can purchase loans. Mina? Good. All right. All right. I'm just trying to see who's there. Let's see. I kind of see Perla. Luz is gone. Oh, there she is. All right. She's good. Let's see what's up with the chat. What we got. All right. Who else? Catherine, I see. Moses, Natalie, Peter. You guys are so mean to me. Like, couldn't you wait to eat, like, during the break or before the class? You always do this to me. It's like I give my best to you guys, and you just give me your worst. Like, you eat right in front of me. Like, hey, here's food. I see how it is. And then some people are cooking. Like, right, Susanna? All right. Let's look over here. We got questions. Let's see. Daphne. So Daphne's question is, wraparound mortgage. Wraparound mortgage and seller financing sound very similar. Can you explain the difference? There's no difference. Wraparound mortgage is a type of seller financing. Type of. Just like lease with rent with option to buy is a type of seller financing, kinda, because you're giving opportunity for them to jump in during a small period of time. The difference here in this type of scenario is there a mortgage in terms of wraparound mortgage? Is there an existing mortgage that's not being paid off right away, or there's no mortgage and it's strictly between seller and buyer? If there's two mortgages, the one that the seller has and the one that the buyer and the seller agree to, then one mortgage wraps around the other mortgage. Okay? If I don't have any debt, like the property's free and clear, I have no debts, then a wraparound mortgage does not exist. It's still seller financing. But wraparound mortgage is where you're buying from me, but I still did not pay off my bank. Okay? So you pay me, I pay the bank. That's what it is. Good? Daphne? All right. Next question is, in chapter... Yes, so consumers are the applicants in terms of mortgages. Consumers are the applicants. Janice, I see your question. I'll go over that in a second because apparently there's part of it here too. So when they mention consumer, do they mean the applicants? Yes, consumer is always the borrower. Yep. So the applicant, always, the consumer. Because it's a consumer of a service. What is the service? The lending. Right? If I'm the lender, I'm lending to you. You applied for it, and you're the consumer of a service that I'm providing to you. Yep. Then Perla says, and on page 217, the new 3-day waiting period is, let's go to page 217. Okay, page 217. Perla, you're talking about this? Hold on. You're talking about this? Okay. So what is your question here? Because you just wrote... Okay. That's what you're saying after. Okay, I understand that every time there's a change on the LE, there's a new waiting period begins. Correct. So When I apply for a loan, so I have a complete application, we have aliens, right? The address of the property, the loan amount that's being requested, the income that I have that's provided, the estimated value, right? The name of the borrowers, and the social security. So aliens, a completed application, right? Within 3 business days, I have to provide, so Janice, this will also answer, I think, whatever issue you have. It's going to go here as well. By providing a completed application, the new rule, as of October 3rd of 2015, the new rule is that they have to give you a loan estimate within 3 business days of the completed loan application. But what is a loan estimate? As the name says, it's an estimate. So it's not guaranteed. So if anything changes, so does the loan, right? So that's why I wrote here, what will trigger a new loan estimate? And I said if the loan, see, these will change the terms of the loan. If any of these happens during the time that we're waiting to close, right, then that means that the loan terms change. If the loan terms change, then the lender has to provide you a new loan estimate. So they have, again, that's why it says triggers a new 3-day waiting period, right? It triggers a new 3-day waiting period. That means that the lender has to, within the 3 days, business days of the change, provide you with a brand new, or reissue a brand new loan estimate. Okay? Perla? That was it? Okay, great. Janice, let me know if that was the question. If not, then write it down so I can address it. And Daphne, okay. So Daphne goes, the wraparound mortgage is the second loan. I understand the concept. You pay me, I pay the bank. But where does the second mortgage come in? Is there only one mortgage? Who takes out the mortgage? Is the new owner paying the old loan? Okay. Check the video that I have on Wraparound Mortgage. I know that one is there. So go on YouTube channel and search the Wraparound Mortgage to watch during the break or later. But the concept is simple. Look right here. It's not that there's a second mortgage. There's 2 mortgages. There's a difference between first mortgage and second mortgage on the same person, or 2 mortgages on the property. Okay? So first mortgage would be, so first mortgage, and let's say that it's under John, the owner. Okay? If I have enough equity, then I'll get a second mortgage, still John. Okay? So this would be, in this example, Daphne, this will be a first and second mortgage. It's still the same owner, John and John, right? So here I have a $300,000 mortgage. Here I have $100,000 mortgage, but it still belongs to the seller. Okay, these need to be paid off when there's a transfer of ownership. You got it? So this has nothing to do with a wraparound mortgage. Nothing. I could have these 2, so there's a first and second mortgage. When I meant 2 mortgages on the property, let me erase this here. In a wraparound mortgage, I don't know why this keeps bouncing back. Let's say there's a $300,000 mortgage that I'm still paying off. Okay, that's the original mortgage. But then here comes Daphne. Okay? And you get what's called the wraparound mortgage. It's considered a wraparound mortgage. Why? Because you told the buyer, the seller, I really want to buy your house. I don't have credit, so I don't get approved with the bank, but I have the income. I have the down payment. I have enough income to pay the monthly mortgage. I'm good. I'm golden, right? But the bank doesn't give me money. Would you, John, right? Would you, John, allow me to purchase your home and I'll pay you with interest? All right? So let's say you're buying a home for $450,000. Okay, my explanation on the video is a little different. I'm just trying to give you a quick synopsis so we move forward. In the video, it's a lot more detailed. So let's say I'm buying for $450,000. Because I'm borrowing from you, I'm borrowing at, let's say, 8%. Right? That means I pay seller. I mean, Daphne pays the seller. Right? And then the seller, if you pay the seller, did you pay enough to pay off this mortgage, this original mortgage? The answer is no. You're not paying enough. You just put a down payment, let's say a down payment of $100,000 down payment, and the rest is the financing. So you still owe $350,000 at 8%. So because it wasn't enough, John is still responsible for paying Bank of America. Okay? So that's why I said I pay you at 4%, let's say. Okay? So right here, the concept is this. Daphne, right here, you pay John, and John pays Bank of America. All right? So your mortgage wraps around John's mortgage. You're paying, right? So right there, you're paying John. John pays Bank of America. There's two mortgages on a property. There's no second mortgage because these two are independent. One to John and one to Daphne. Okay, when we say second mortgage, that means a second obligation of the same person. So there's two mortgages, but these are independent. There's not two obligations to the same person or on the same property. Okay, so if Bank of America wants to foreclose, they're going to foreclose based on John's mortgage. They don't foreclose based on Daphne's mortgage. You got it? That's the difference. That's why it's so important that there's that protective clause that we talked about. The protective clause that allows you, Daphne, to go around if there's a default. So you go around to the bank directly. If the seller, if John stops paying Bank of America, you have to have a protective clause that allows you to bypass so you don't lose the property. Because again, you don't exist to Bank of America. John does. So if John stops paying, Bank of America goes after the property based on John's mortgage. Okay? You guys got it? How are you talking about? You're talking the third person now? How does Daphne take a mortgage? Is this really affecting you that much now? So let's figure out how Bruno does this, right? Who's Bruno? All right, so your question is, how does Daphne take out the mortgage? What do you mean takes out the mortgage? There's no taking out of mortgage. Okay, it's a mortgage loan that the seller allowed you to have. So instead of collecting the whole $450 up front, the seller says, give me $100,000 now, and the rest pay me every month, let's say $1,000, which is the equivalent of 30 years at 8%, let's say. You got it? And then once you finish paying that off, the house is yours. Simple as that. It's called down payment. How do you know what, Perla, how do you know what she's asking? It's called down payment. Either you have the money for down payments or you have the credit. Okay? She just said yes, Perla. Is it financing? No. Look, when you buy a house, we talked about this in chapter 13, 14, and 15. When you buy a house, you have to give a down payment. Right? So let's say it's $20,000. In this case, I said $100,000. Because it's a high-risk mortgage for the seller if you don't pay. So that's why they ask for a little bit more down payment. But let's say it's only $20,000 down payment, as an example. Where does that come from? From your bank account. Where does the rest come from? It's a credit that's extended to you. Here, The credit was extended by Bank of America, and that's why you pay Bank of America. Here, that credit was extended by John. It's simple. I'm going to give you a loan to buy my house, but I don't give you the money. I'm just allowing you to buy that property for me. So that's what credit cards are. How does the credit card show up? Do they give you cash? No, they tell you, hey, here's a limit. It's available. Do you want it? That's all it is, right? Here's the same scenario. Think of this as a credit card, but then you bought the house with it. The seller extended credit to you. They asked for $100,000 deposit, right? And the credit is for the difference, $350,000 at 8%, which you pay over time. So think about it now as a layaway. You're paying, but you only get the title to it at the end. That's the security that the seller has in this scenario. Okay? So Daphne enters into a mortgage loan with John. Absolutely. Okay. So the mortgage stays in the name of the seller until Daphne pays John. Okay, so let's understand what mortgage is and what promissory note is. The house is under, in this scenario, the house is still under John's name. The house. Okay? The mortgage, what a mortgage is you giving up the house before, in exchange for credit. So what John has, Perla, he's the mortgage holder, or he holds a mortgage. That means he holds the rights to foreclose on you. That means he holds the right to kick you out of the property. That's what it is. That's what a mortgage is. A mortgage loan is the credit. It's that amount right there. That's a mortgage loan at 8%. A mortgage represents the house. So John has the right to kick you out if you don't pay. Okay? So I just want you guys to clearly understand what is a mortgage and what is a promissory note. These are two separate things. One represents the house, the other one represents the loan. And there she goes, talking to herself in the third person. So Daphne asks, so John gives Daphne the money. Yes, Daphne gets the money. Okay, Daphne? So no, there's no actual money exchange. There's no actual money exchange. Because why would I give you money for you to give me back on my house? Okay? There's no actual money exchange. But I give you the credit, and you're acting in good faith, and I'm accepting that good faith that you will pay me over time that money that you just borrowed from me. That Daphne, not you. Daphne borrowed from me, okay? Next. So if John has the money to loan Daphne, why doesn't he just pay off? I just explained. There's no actual exchange, right? Yes, the credit is already in John's hands, which is the house, pretty much. Got it? Okay, I see somebody typing. While you're typing, I'm going to do the roll call again because now there's more people. So we got Steven, we got Carlos, Susanna's gone, Perla, Luz. Oh, there she is. Okay, Susanna's back. Jane, Anthony, Geraldine, Lena, Chad, I don't know where you are, Daphne, Gil, Catherine, Mina, Youssef, Natalie, Peter, Heather, Ice Cream, Nicole, Moses, Abanu, Brian, Meredith, Talia, hi again, Vanessa. By the way, Talia came to tour the office this morning, so if you guys want to, you can always tour the office. Vanessa, Joseph, David, hey, David is stationary, miracle. Yanessa, Riley, Yamili, and Jessiel, how you doing? Jessiel is back in class. So Yamili, you always have somebody extra with you, right? Where's Tidy? Oh, she's there. Okay. All right, just no camera. Ah, there she is. Cool. And who's that in the background? There's somebody else. Oh, the boss. The boss is there. Hey, boss. All right, so Gary, Sarah, Sandra, I see you. Sabrina, where are you, Sabrina? Myra, Pedro. Pedro, why are you logged in twice? There's 2 logins for you, Pedro. Chloe. Daphne. Okay, cool. All right, so the rounds. Let's see here what the question is. Not a question. So, I got it. It's okay. I can't with you guys. So the question was, Daphne, I'll watch the video to get more info. If I have further questions, I'll email you separately. Okay. All right. So I was just giving you an opportunity to write the question, but definitely watch that video. You have to know the difference between a loan and a credit. I did explain to you what a line of credit was in the home equity loans. A credit is like a gift certificate to something, right? So you don't get the actual cash, but you can go to the store and redeem and get a discount. So a credit is that. In this case, a loan is a credit. So you're paying in installments to be able to purchase that house. They extended the $450,000 credit. Okay, that's all it is. But go through the video. It's a pretty good explanation of what a wraparound mortgage is, I think. If you still have questions, let me know definitely. And guys, if you have any other questions regarding the previous chapter, let me know before we jump into this one. Just put you know the rules, just put a question mark. So I know you're typing, otherwise I'll just move forward. So he's the creditor. Yep. So you come to buy my house, Daphne. You come to buy my house, and I'm telling you, you can buy my house. I'll give you a 30-year credit on the purchase, and the purchase is $450,000. But to get this credit where you can pay me in installments, you got to give me a deposit. That deposit is whatever we agree, $20,000, $30,000, $40,000. But then I'll give you a credit that allows you to pay me in installments instead of paying all at once. That's what it is. Okay? Oh, apply. I was trying to figure out, why didn't you just write Samsung or something? I mean, Apple, right? Anyway, next. So you got it. Any other questions, guys? Take advantage now before we actually dive into this. No questions. Oh, there you go, Sarah. I don't know anything about shoes, Sarah, so if that's a question, I don't know what to answer. Just saying. That's your question? All right, so you should have received, first of all, you should have received an email from PSI, but if not, again, send me a message with that, and I'll separate, and I'll take care of that. Now, if you go to the student portal, let me see if I have it here open. Now, let me just open up the student portal for you guys. Okay. So, don't you love technology? All right, so you're going to scroll down to where it says access to course resources. And then if you scroll down here, it's going to say pass the school exam. Then go here to find out how to schedule your state exam. You click there. There's the steps on how to do it. All right, and here to take you to PSI to schedule. You're welcome. I'm trying to make it easier. As easy as possible for you guys and make it as clear as possible for you to get all the resources. All right, so if there's no further questions, what I'm going to do is start the class. We got 42. Okay, oh, hold on. Mina Angel got a question. Okay. Not really. A lot of people don't even know where the student login is, so don't worry about it. So Mina, what's your question? 3-day right of rescission. Oh, you want me to recap? First of all, rescission is cancellation, so that's simple. Rescission is cancellation. So when we're talking about rescission, we're talking about canceling a contract. Okay? In this case, we're talking 3-day right of rescission is canceling a loan. Because it's under mortgages, it's canceling a loan that's backed by the mortgage, the house, right? So what you need to remember is that because it's a loan, most banks are open on Saturdays, so you got 3 days, 3 business days to cancel the loan that you just got yourself into. But this only applies to refinances. It does not apply to purchase. Refinances, not purchase. Let me know if that helped you. Sorry, just give me 1 second. Okay. All right, so Mina got it. Let's go to the book. All right, so chapter 16, appraisal. Just want to show you one more thing that I showed Talia this morning. When you go to resources, all right, so real quick, for those of you that have completed the exam, that have completed the 75 hours, or when you're close to completing 75 hours, make sure you do this. Look, it says right here, I have everything laid out in the student portal. If you completed the at least 90% of the course, test yourselves. It says right here, test yourselves. It takes you to a link for you to do the school test. It's not the official test, but it's very close to it. All right? So make sure you guys take advantage of that. We got Quizlets. Go to the Quizlet. Give it a try. All right? Even before Daphne says something. So even with all the typos, I know. But it's very helpful because it's like flashcards. But Quizlet is more for concepts. It's not really for you to test yourself or anything close to what the state exam is. Now this one is very close to state exam questions in terms of style of questions. Okay? So Quizlet is for you to grasp the concepts. All right? But this is the one where you actually test your knowledge. So as soon as you complete 90% of the course, I recommend that you do this one. The Quizlet is good as you go. This one, as soon as you complete 90%. Okay? And you can do it as many times as you want. I pay for it, but for you it's free. Just take advantage. Do it. Okay? The resources are there. If you're not on Quizlet and if you're not taking advantage of this student portal here, the replays and everything, right? The replays. Right here, the end of the chapter, there's the review quizzes, PowerPoints. If you're not taking advantage of this, then you're wasting a lot of opportunities here. This is really helpful to get to. Okay? It also says here, if you guys don't know where my YouTube channel is, just in case, it's right here as well. Under Access Course Resources, watch past videos on YouTube channel. You can search, we just talked about the wraparound mortgage. There's a video about it. Yesterday we talked about points. I have something there, adjustable rate mortgages. I'm constantly uploading videos to the YouTube. So just make sure you take advantage. All right. As you guys see here, this is the stuff I'm working on. I'm adding, right now, most of these go through third parties, but I'm now adding my own course on life and health, property casualty. We're going to have our CE credits right here. Property management. We're going to have also home inspector courses. So a lot of courses are going to be added right here. Right now there's nothing. You guys don't have access. Right? There's nothing here. You would have to pay for these, obviously. When you take the course, this will open up and give you more things just like this, right? But that's why it's here. So just take advantage as much as you can. All right. So this right here is my way of guaranteeing that you will pass, kind of guaranteeing that you will pass the exam. Just use the resources. Okay. So that was it. Where do I go? Okay. Gil says, I might lose you. I'm not going anywhere. Did we just lose Gil? Yep, I guess so. All right. Is there different versions of the practice test? Actually, I did put there, so you guys know, there's almost 600 questions in my practice exam. Almost 600. And I keep on adding more questions. So, Susanna, the exam is not 600 questions, okay? I saw your face. It's not 600 questions. The practice exams, they're all 110 questions, just like the state exam, just like the school exam. What I'm saying is that the question bank, the database, has over 600 questions, revolving questions. So if you take the exam again, you will have most likely new questions. Okay, so it goes from the 600 questions. That's what I'm saying. All right, and I'm hoping to have thousands of questions added over till the end of the year. Okay, so it's just to make it helpful for you guys. Luz, when is our last day of class? Next Friday. Gil, power's flickering, storms, bad, but I'm here. Gil, how far are you? I just want to make sure it doesn't get to us. Edison. Okay, so it's still far from me. Okay. All right. Let's see. Carlos, you back at the house? Good. I was just giving you time to get home. There you go. All right, let's go. Appraisals. So, appraisal. What is an appraisal? Things to know, things to remember. An appraisal is an estimate or opinion of value. So, every time you hear the word appraisal, means estimate or opinion of value. Okay? So, we're not talking just about real estate. We're talking about in general. When you appraise something, is when you attribute your opinion of value to something. Like, hey, this computer that I'm using, the computer that I'm using is worth $1,500. There's different points of view, and that's why I want to point out the fact that it's an opinion, right? There's different points of view to the same thing, right? So my view, you guys are all seeing this, right? The screen, right? Good. See, this is your view. Is you're seeing the screen, you're seeing me, you're seeing the logo, you see everything that's here, right? I can see it too. But my perspective is different than your perspective. Do you understand what I'm saying? So when it comes to appraisals, just like realtors, we do the comps, we're going to talk about this later, it's all based on opinions. And because it's based on opinions, appraisals can also be disputed. We can say that the appraiser might be off, might be wrong on their estimate or their opinion. You guys with me so far? We can estimate everything. The value of this computer, the value of this tablet that I have right here where I'm writing this. This is a tablet, so you guys know. It's a tablet. The value of the camera, the value of the book that you guys purchased, the value of this class could be worth more, could be worth less. Everybody has a different point of view. But when it comes to appraisals, it's a professional service performed for a fee, and it's regulated, state regulated. Okay? So it's not just, hey, this computer is $1,500. No, I went through a course where I learned how to determine supportable evidence and what are the approved methods for appraising a property. You guys got it? So it's still an opinion, but based on supportable evidence and approved methods. And you guys are going to learn most of those today. Now, an appraiser is an independent person trained to provide an unbiased estimate of value. Okay? Independent. They don't represent the seller. They don't represent the buyer. Like a title company. Doesn't represent either or. Let's go to the right-hand side. Now, it is commonly agreed that land possesses these 5 attributes. It's finite in its supply, or finite in its supply, whatever way you want to call it. I've heard some people say finite, others say finite, but you don't say infinite, you say infinite. But anyway, whatever, English, semantics. So finite, meaning no more land is being created. Okay, there's an end. If it's at infinite, means it never ends, right? But there's an end. There's no new property being created. Also, can't move it. It's immobile. Can't move it. Land is land. You can remove dirt and put it somewhere else, but the location of land, it's immovable. It's there. You guys got it? Can you move your parcel where you live right now? Can you move it to a different country? The dirt, yes, right? But the land, that square or rectangle where you live, you cannot. That's its location. It's durable, meaning it lasts a long time, right? At least like 100 billion years so far. Each parcel of land is unique and has its own unique location and characteristics, and it's useful to people. So these are the 5 attributes that we initially look at to determine value. Okay? Now, real estate and the business of value. Real estate industry deals with real estate and its value. Now, value is not the same as price, nor is it the same as cost. So we're going to talk about this, of what value, price, and cost are over the next page and a half. But it's very simple. Value is what so right here, it's the present worth of future benefits. You buy something because you see value in it, right? That's why you buy it. You're willing to pay the price, estimating a future value. Some people buy, let's say, a $5 shirt. Other people buy a $500 shirt because they assume that more expensive, more value, it will last longer. Not always the case, but everybody has a different opinion, a different estimate of value. You guys got it? Yes? Okay. And I'm saying this because I just had an argument with a friend of mine yesterday regarding a $200 sneakers, right? And all because of the brands. It's the same sneakers that you can find for like 70 bucks. 70 bucks. Same exact sneaker, but because of branding, right? Now it's worth $200, like Supreme, if you guys know Supreme, the brand. So the point here is everybody has different perceptions. Some people are willing to pay the extra value. Other people are like, hey, it's the same sneaker. Meaning it's the same house. Why do I need to live here if I can live here? Right? It's the same exact house. And sorry, Chad. Listen, I didn't mean to do you like that, man. My point was attributing value, estimating value, how we perceive things, okay? Gary said, I'm a stylist, and just because it has a brand name on it doesn't mean it's good quality. I know. That's exactly my point. But people perceive it as it does. So sometimes branding is enough for you guys to charge more. You got it? That's what people do all the time. You reverse the roles. That's what it is. I'm the bargain shopper. Anyway. All right. So, but what is price and what is cost? See, price is what you pay today. Value is what you're looking at, future value, how long it's going to last, what it's going to give you in return, and so on, right? And cost is obvious. How much did it cost to manufacture, as an example, right? How much did it cost to build the house? It cost $200,000. How much are you charging for the house? $300,000. How much is the house worth in the future? Well, between rentals and appraisal, like increase in value, so appreciation, depreciation for taxes and all that stuff, that $300,000 house is worth $500,000, $600,000, or even $1 million over time. Does that make sense? So we built it for $200,000, sell it for $300,000, but it's worth $1 million over time. So cost, price, value. You guys got it? Give me a thumbs up if you got that. Great. Now, obviously, it says right here that the value of real property does not remain the same over time. I just explained over time, traditionally, there's appreciation, so it increases value. And changes, obviously, in the cost of construction, right, can increase the objective value of the property. And, of course, differing standards and needs can also alter an estimate of value. This is what we're finding right now. It's not going to be in the state exam, but I want you guys to understand this. Because we're going to talk in a second about supply and demand, right? Because you cannot determine value if you don't know what the supply is and what the demand for that supply is, okay? So that's probably one of the key factors for any type of business is supply and demand, all right? For real estate, there's an additional, even more important factor, which is location. But housing shortage. There's not much inventory on the market right now. There will be, but right now there's not. So if there's not enough, but people want it, right? There's not enough supply, so housing shortage, but people want it. What do you guys think is going to happen to the value of even older homes? Let me know in the chat. There's not enough supply. There's not enough supply. Okay, let me go to the chat. But there's a lot of demand. All right, I don't know if you guys heard it, but Gil already sent the thunders here. Yep, I just heard it. Correct, so skyrocket goes up. So that's what's been happening over the past 5 years, right? I mean, it's been increasing for a little bit longer than that, but for the past 5 years, it just skyrocketed. If you guys noticed, so I sold a house almost 5 years ago, and it had already increased $80,000 in value. But if I were to sell it now, let's say I kept the property, instead of selling for $465,000, the same property I could sell it for almost $700,000. So look at the difference. Like over almost 4 years, look at how much it increased from $465,000 that I sold it for to almost $700,000 now. All right. So these are things to consider. Hold on. How did she unmute? Linda steps in and already starts talking over me. It's unbelievable. All right. Okay, so yeah, Perla, you were seeing Linda because she took over and decided to unmute and all that stuff. Don't do that face, Linda. Yeah, it was you. People get in the car and stuff. This is awesome. You guys running away from the storm? Susanna's like, day one, he's picking on me. Yeah, I am. Well, it's actually day 1.5 because you were there for a few minutes before. Anyway. Linda is hilarious. Yep. All right. So, Gary, what happened to you? Sorry. Got it, Heather. I see. Gary, are you typing? There is Gary. Yep. Okay. Just want to see what happens so I know. Oh, that's it. I thought you were going to say something regarding the class. Linda popped up. It popped up in everybody's screen because if I give you guys the mic, then automatically you are the speaker for that moment. All right. Next. So you guys understood that supply and demand goes up. Great. Gil, I know I ignored what you said about crash and all that stuff. Just moving forward so I don't lose track of this right now. But the answer is yes. Next, real estate concept of cost generally relates to the past, price to the present, and value to the future. I already covered this. Cost is how much it costs to build. Price is what you're paying now. And value is what you expect in return for that investment. Okay? Now, what about this word? Those of you that already know the answer, please. If you already know the answer because you were in my previous class, then I have to answer. But what about this word? What does this word mean? Let me know in the chat. What does this word mean? Situs. Don't read in the book. Just tell me what you think it means. Don't Google it either. Just tell me what you think it means. And those of you driving, do not type. Please keep your hands on the wheel. Location or where it's situated. So situs, situated. All right, so when we're talking about situs or situs, whatever way you want to pronounce, I'm not your English teacher, so I really do not care about that. I care about you passing. So if you want to know how to pronounce it, go ask somebody that teaches English. But situs is, or situs is where it's situated, and it's the location of the property. Why? Because these are the three most important factors for valuing real estate. Location, location, location. So where the property is situated, where it's located, it's what really determines the value. Think about it this way. We talked about this when we talked about Texas. So for Heather and Chad, right? This popped up in a previous conversation where you can have the same house here that's worth $1 million, right? But you go to Texas, in certain areas of Texas, for instance, and that property is worth $300,000 or $400,000, right? It's not that it's a lesser property, is that depending on the location, they attribute different values based on the economy there. It's still $1 million house for you, right? But the same house, now you go to New York, and it's now worth $3, $4, $5 million. The same exact rendering of the house in different locations will give different values. But also the material, the cost to build is going to be different. The demand is going to be different. You guys understand? So location is a key factor. Chad says there are homes that are $60,000 that would be about $400 here. There you go. So you buy don't buy a $400,000 house here, buy a $60,000 house in Texas. There you go. And good luck trying to get a license for real estate in Texas. You have to learn how to do contracts. It's like double or triple the hours. It's ridiculous. You have to be pre-approved to take the license. I know this because I have a student of mine. They didn't even accept the credits of the classes she did here. Right? Because there's no reciprocity, so they don't care. Oh, Jersey? No, doesn't count. Take the whole class again. Crazy. Anyway. So it's not the hardest one in the nation. It's one of the hardest ones. So you have Florida as well. They tell you to prepare contracts. In Arizona, you have to prepare contracts. The fact that you have to learn law makes it very difficult for you to pass. It's the fact that you have to learn how to the whole law of contracts. See, chapter 11, we just brushed on law, okay? When we talk about contracts, them over there, forget it. You have to know even statutes and everything. It's crazy stuff. But it's one of the hardest in the nation. Yep. All right. Real estate market, guys, we already talked about this. We talked about supply and demand, right? We already know if supply increases, right? If there's a lot of supply, then it's cheap as bananas, right? There's a lot of supply, prices drop. When it's something unique, right, and people want it, then prices rise, okay? Very, very important. Supply and demand, we covered this already, so you guys know. Any questions here on supply and demand? Don't forget to put that question mark and let me know. No question mark. Cool. All right, on the right-hand side on top, value. So we're going to determine value of a house. For a property to have value, in the real estate market, it must have 4 basic economic characteristics, and it's the acronym is DUST. So what is the first one? Demand. As we just talked about supply and demand, right? So if there's not enough demand, then the value drops. If there's demand, so being needed or desired by someone who can afford to buy it, then prices rise. Utility, that means being capable of satisfying human needs or desires. And Gil, that's why the acronym you used doesn't work. It does, but it doesn't. But because of the wording right after, it doesn't help. Scarcity, being only available in the limited supply. So we go again to the fact that if there's demand, if there's demand but there's a lot of supply, then prices really don't rise, they don't low, like if it's even, right? So limited supply. And the last one, transferability. What does that mean? That I'm able to sell it to you, or are you able to buy from me? Simple. So for a property to have value, you must have these 4 characteristics. So it's dust, or as Gil said, stud. Whatever works for you guys. Market value. Market value. See, a given any given parcel of real estate may have different kinds of value at the same time. We're going to go over this later on. There's the value for taxes, value for a divorce, probate, so on, right? So there's different values to it. But often the goal of an appraisal, or the most common goal of appraising a property, is to estimate the market value, right? Just like we do CMAs, comparative market analysis, is trying to figure out what's the most accurate market value, okay? Now, the market value of real estate has been defined as the price, pay attention to this one, as the price that a ready, willing, and able buyer who is not forced to buy will pay a seller who is not forced to sell after the property has had reasonable exposure on the market. So these are keywords. Think about this. If I'm forced to buy, let's say I'm relocating and I have to be at my job on Monday morning, as an example. That means I only have a few days to buy the property, right? Or to rent a property, whatever it might be. Am I looking at the property with what we call seeing eyes? Like, am I paying attention to the details of the property? No. So I'm being rushed into a decision because I need it. So that's not the true market value. If a seller is being forced to sell, I have to sell because I'm going through a divorce and I need to finalize this divorce. I can't do this anymore, right? Am I in the right state of mind in the price that I'm giving for this property, or I'm just trying to let go of the property? You see what I'm saying? So if a buyer is being forced to buy, then they're not giving the true value of the property. They're paying whatever value. If a seller is being forced to sell, they're not keeping the most value of the property. They're just trying to get whatever value. Okay? So the true value of a property is when neither party is forced. Is when, hey, I want to buy, and you want to sell. Great, let's do this peacefully, calmly, nothing pressuring us. You guys got it? But there's another factor right here, exposure. So in both of them I said not forced, right? But then there's this one, exposure of the property. So as you guys probably realize, some of you that have tried to buy properties or have been looking at the market, you probably realize that a property is listed today and tomorrow you want to go see it and it's already under attorney review or under contract, like from one day to the other. Do you think that's the best value? Whatever offer was accepted, do you think that's the best that we can get? And I'll tell you one thing. A couple days ago, one of my realtors had a listing, and in that listing, the value was listed for $375 as an example. Okay, so it was $370 or $375. It was listed. Thanks, Gil. I see it. Here's the same. So it's listed for $375. He received an offer of $350, like lowball offer. Okay. And one of the things that I told him was to hang on to it. Great. Let him know that you're going to do another open house. Let him know that you're looking for highest and best because they're a little off on the price. We're not rejecting the offer. We just expect more offers, right? So pretty much just showing that the seller's not desperate, right? And for the buyer to not force that sale. So for the buyer, if they really want it, let's look at it again. Guess what? The offer that came in after from a different buyer was at $380. You see what I'm saying? A lot of these realtors are forcing the seller to accept the very first offer that comes in. Great, hey, take it because we don't know what's going to happen. Take it. No, there has to be reasonable exposure of the property. That means there have to be enough bids. And what I like to compare it to is if you've ever done popcorn in your lifetime, right? If you've done popcorn or made popcorn on the either microwave or if you put it on the stove, whatever. If you've made it, then you already know that it starts popping. Great. That means the offers are coming in. It starts slowing down, then that's bad. If you keep it there, it's going to burn, right? So that's what it is. With real estate, you need to have these offers come in. It's not at the first pop that you turn off, right? And you open up the pot and you start eating popcorn. No, it was one pop, one offer. Is that the best you can do? You guys understand what I'm trying to say? So you want all these offers to come through, and if it starts slowing down, then I think we should evaluate the offers that came in and see which one is the best for you, Mr. Seller. But that's not what's happening. They're just accepting whatever. First day listed, first day offer, take it. Not the right way to do it. That's not reasonable exposure, and that's not the best market value. So market value is the most probable price that a property will bring. Most probable price that a property will bring. Okay? Remember this. Market value is the most probable price that a property will bring. Next, the payment must be made in cash or its equivalent. Sorry. Daphne, probable, more like profit? No. All right. All of us, we're going to go around a block, a particular block, and we're going to start pointing. All right, if you guys want, we'll do this one day. We're going to point at properties, and we're going to go. So we'll do like a little real estate tour. Let's call it like that. We're going to look at the properties, and we're going to like, this one right here is 300,000. That one right there is 400,000. Right? This is our opinion. Okay? Our opinion. What does that mean? It means what you would offer if you were the one buying. Okay, Daphne, so far? Okay, so what I'm saying is we're gonna evaluate the properties based on what people are willing to offer. The most probable price is the highest price that a property can bring. So now between the opinion of 40 people, right? if we all look at the same property and we all determine that this property is worth 300,000, then guess what? Then that's the most probable price that it will bring. Now, we usually estimate this based on recent sales. What are recent sales? 40 people bought properties close by, and they're similar, and they brought an average of 300,000. So what's the most probable price? 300,000. The profit is 300,000 sale minus whatever you put in. You take home money, that's your profit. Okay? So most probable price is not profit. It's what the market will sell it for. Okay? Now, yeah, I knew David was not going to stay still for too long. He's in the car already. All right, next. Gil's asking cash or like collateral. So no. So I understand what you mean by collateral, but cash or its equivalent, we're talking about a cash or its equivalent, which is mortgage, for instance. Right? So where you give up the property as collateral, yes. But cash or equivalent. Could it be an exchange? So house for house? Yes. So that's another equivalent. Okay? So exchange of value. Next. Both the buyer and seller must act without undue pressure, and we already talked about that. They cannot be forced into buying. Reasonable length of time must be allowed for the property to be exposed on the open market. Again, it's not listed today and accept any offer that comes in tomorrow. No. Reasonable exposure, enough length of time. So think about it. What is enough length of time? At least 4 days. Let the world know that the property is available, right? Let people see the property, at least 4 days, right? You guys don't have to write the 4 days. It will not be on the exam. I'm just giving you an idea of what you consider reasonable. Give it at least 4 days for the popcorn to start popping. So for offers to start coming in. Do you understand? For people to see it. So we can have the best price. Next it says, very, very important. Both the buyer and seller must be well informed of the property's assets, defects, and potential. Okay? So, what are we saying here? Very simple. You cannot hide anything from me, and I cannot hide anything from you. We know, both of us know exactly what's going on with the property. You guys got it? Both of us know the potential of this property. So who's going to tell us this stuff? Realtors, we're supposed to dig this information. This was chapter 3. We're supposed to dig as much information as we can regarding a property. So that's chapter 10. We're supposed to know as much as we can for the buyer. That's chapter 11 when we put an offer. You guys got it? So it is our duty to try to get all the information on assets, defects, and the potential of this property. That's what will determine the market value. Here's another thing that's important about market value. Arm's length transaction. What is an arm's length transaction, guys? It's one that it's between two relative strangers. What is relative in this case? Is we're saying, hey, I might know you, but you do whatever is best for you, I do whatever is best for me. Because when it's friends or family, right? Friends or family, we usually tend to negotiate it a little bit better so nobody's hurt, right? But if it's a relative stranger, like, hey, Gil, how are you? Right? I'm the seller, you're the buyer. Gil, I'm not going to compromise. You do what's best for you. You negotiate the price lower, I'm going to go negotiate it higher. All right? It's people that we don't keep in a close circle, right? I'm not saying, you understand. You're not keeping it in a close circle. You keep at arm's length transaction. I'm here, you're there. Don't come closer, let's shake hands and close the deal. It was a good fight. Thank you. You guys understand? That's arm's length transaction, and that's very, very, very important for market value. Okay? Everybody's trying to do what's best for them. Take a note on that. It is raining and thundering hard outside. Did you guys hear it was going to snow in August? It's a joke. I don't know if it is. It's a joke, but we're kind of late on this weather, just saying. All right. Next thing. 224, page 224. We got value versus price. Chad, maybe. We don't know. The rules are going to be happy. All right. Value versus price. What is the difference between value and price? We already said that value is the future expectation of this property, right? With future benefits. Price, when you see market price, it's the selling price. What a property actually sells for. Market value is what we expect. So going back to Daphne's question before, probable, is it more like profit? No. When we're talking about probable price, is what we expect to receive for the property. We expect 300,000. Can somebody offer 320? Right? If they do, then and we accept, then 320 is the selling price. The value was still 300, but somebody offered $20,000 above. Can somebody offer 280? Lower? Absolutely. And if you accept it, then that's the selling price. So the difference between value and price is simple. Value is what we list for, what we expect this property to bring. Could it bring more? Yes. Could it bring less? Yes. Could it bring listing price? Sure. Okay? So there's a big difference between value and price. And there's a lot of questions on appraisals in the exam. They increased it 2 years ago in December with the new exams. They increased the amount of questions for appraisals. Even though we don't do appraisals, right? But we do estimates of value, comps. So should we know about this stuff? Yeah. Okay. The next one is market value versus cost. All right, Janice, I just saw your message. Storm knock out your cable. Yeah. And I'm hoping that it doesn't knock out anything here. All right, so market value versus cost. So I already told you that cost is related to the past. How much did it cost to build a house, right? Value is what we expect to get from the property. So cost and market value may be equal when the improvements are new. They may be equal, maybe, it's not guaranteed, when the improvements are new. That means it's a brand new construction. So why is it important for you to know this? Because if it's a brand new construction, how can we compare to other properties? It's brand new. So what's around to compare it to? Nothing. So how do we estimate value? Well, most likely based on the cost of the property. Are you guys understanding this? If it's older homes, then it's easier because we're going to compare it to homes that were built 10 years ago, 20 years ago, right? So apples to apples, right? But if it's a brand new home in the middle of 30-year-old homes, then it's comparing apples to oranges. It's very difficult to come up with an exact or accurate estimate. Are you guys with me on this? Okay. I'll wait for the question. Did you guys hear the thunder? Yeah. Okay, we got Daphne with a question and Yanessa with a question. Okay. Probably, Heather. Probably. After seeing you guys eating and having dessert and everything, yeah. All right, let's go here. All right. Doesn't it cost less to build a house and cost more when you sell it? Yes, so obviously you're trying to get profits out of it. What we're trying to say is that, actually, let me show you here. So, and that will address also Yanessa's question. Let me show you here. Most of the times, so more often, cost does not equal value. Why? So we're talking about, you have to understand what an appraisal is. We're comparing to other properties. Okay? So when we say that cost and price are the same is when we're looking at two similar homes and we determine, hey, they cost X amount of dollars to build, so their value is the same. Because for us to estimate value, as I said, we have to look at recent sales. Okay? So, hold on. Let me just close this door. All right. Let's see. I walk right into the book. I'm like that, yeah. So we're getting into that, Yamili, right now. So what we're saying here, guys, for instance, two homes, we need to compare. First, to figure out value, we need to compare different homes. All right? We're going to talk about this in a second. But let's say there's this block, and there's a bunch of homes. And let's say this is all we have to compare. This home sold for $200,000. This home was not sold, was not sold, was not sold. This one sold for $300,000. Not sold, not sold, not sold. This one sold for $400,000. Actually, lower. Let me make it $250,000. Okay, not sold. This sold for $300,000, and this sold for $280,000. All right. For us to do comparables, guys, we have to figure out homes that sold recently. Okay, so that's the only way we can compare. And I'm not going to compare. We're going to go over this as well. I'm not going to compare a home that sold in a different town. I'm going to get as close as I can. So whatever is here, as close as I can to the house that I'm trying to sell. So let's say this right here is the house that I'm trying to sell. I'm going to compare this house to this one, to this one, to this one, to this one, and to this one. So I'm going to compare to these. What is it worth when compared to these, right? If these sold recently, but this is a 20-year-old house, this is a 15-year-old house, this one's an 18-year-old house, and so on. These are old homes, and this is a brand new one. It's difficult to compare. You guys understand? But if this is a 15-year-old house as well, then now I can use all of these as comps. Are you guys understanding this? All right? Good. So going back here, it says right here that two homes may be similar in every respect, except that one is located on a street with heavy traffic and the other in a quiet residential street. So what we just said is both homes that we're trying to compare to ours, right? The homes we're trying to compare, they're both built 20 years ago. They're both single families. They're both 3 bedrooms, 2 bath. They both have garage just like ours. So everything is very similar, right? The problem is one is in a heavy traffic area and the other is in a quiet residential streets. So let me ask you, which one do you think is worth the most? Which one will give most value? Will get most value when we go compare. Is it the one in the residential? Most likely, right? Most likely the residential, absolutely. Okay? So, it's the same house, same structure, same everything. They cost exactly the same to build. They cost exactly the same to purchase the lot. But then when you go sell, they have different values. Okay? When you go sell the property, They have different values because they're located. Remember situs? The location differs. So going back to, okay, Gary, glad you're back. So I know a lot of you are probably power going out. We have that from Janice. I just have that from, we just had that from Gary. All right, so if you guys go out, I'm sorry. Just come back and try to catch up with it, and then we'll, any questions, just ask me. So, what was I saying? So, it costs exactly the same, and like I said before in situs, in location, right? We said that the same house in Texas is worth, the value is a lesser value, right? The same house in New York, it's a higher value. So, it depends on where you're located. The same exact structure costs exactly the same. But the closer you are, most likely, same value. That's what we're trying to say when we say that the price, the cost and the value are similar. The closer you are, the similar value we get. The furthest away you are and location, whether it's residential or heavy traffic, now it starts making a difference in value. All right? So, as it says right here, the value of the residential, of the heavy traffic may be less than the residential, although the cost to construction was exactly the same as it would be the cost to rebuild. Okay? Guys got it? Who asked the question? It was Daphne and Yamili and Yanessa. Yamili, you got it? Yeah. Where's Daphne? Daphne, you got it? Okay, question coming through. And the other one with the question was Yanessa. You got it? You still didn't get it? Okay. Go for it. You get that part? Which part didn't you get then? How do we price? We're gonna get there. Got it. We'll get there. It's coming up. You know, we're building up to that. Let me just wait to see what Daphne's question is. Okay, so the value of the house near the heavy traffic will cost. Okay, value is different. The cost to build is the same. Okay, for the same year, same everything, the cost to build is exactly the same, Daphne. Yes. Value might change because of location. Value and cost most likely are different. That's what we're saying. But the cost to build both of them is exactly the same. So they both cost to build $300,000. But one you can sell for $350, the other one you can sell for $450 because of where they're located. Okay? If they're located in the same block, then most likely they cost $300 to build, and you're going to sell it for $350 both either one of them. Does that make sense? So now it becomes the same, even though so it's based on location, it's based on demand, it's based on a bunch of things. That's what we're trying to say as far as value and cost. All right. So now we're going to go to basic principles of value, guys. And here it's self-explanatory. It comes actually with examples right after. But basic principles of value. How do we figure out the value? Well, first of all, is the current property, build out, at its highest and best use? Like, is this the best thing we can do with the land when we look at it? For instance, if it's a parking lot in the busy downtown area, do you think that's the best thing we can do is a parking lot? With land, that's the best thing we can do? Nowhere, anywhere is a parking lot the best we can do, right? It might be the cheapest thing we can do because, hey, we just got to pave it, right? Might be the cheapest one, but is it the best we can do? No. So maybe putting another building, an office building, and let's do parking underneath maybe. Now that starts giving more value, because remember, real estate is the surface of the earth, right? Down and up. So there's so many more things we can do with the property. You got it? Just a parking lot, scratching the surface, that's all. All right? Now, substitution. What is substitution? Is this instead of that? Right? Isn't that what substitution is? An exchange, or this instead of that, for instance? So substitution here, we're talking about, hey, I'm going to buy, there's 2 houses on the block. Actually, let's go here. Substitution is, you guys go see this house right here, $300,000 house, okay? And then you're gonna go see this house right here. These are 2 listed properties in the same block, as an example. If it's in the same block, we're gonna talk about conformity in a second. If it's in the same block, then most likely all these houses here are the same. Meaning they're all single family. They're all 3-bedroom, 2 baths. So they try to be according to the same standards, okay? So if they're according to the same standards, guys, one is 300,000, the other one is 280,000. One is green, the other one is yellow. Let's say this one right here. This one's yellow. This one's green. Which one would you buy? Would you buy the yellow house or would you buy the green house? They're exactly the same. Everything's the same except the siding color is different. Which one would you buy? It's an obvious answer, right? You go for the discounted property if they're all the thank you. So if they're all the same, right? Got it. Right? Exactly. Paint can change. So, guys, Perla, if you prefer the color yellow, you should know by now that you can do work on the property, right? You know it. Exactly. If you don't like it, paint it. It's not going to cost you $20,000. You got it? Cost you what, $5,000 to change the siding, let's say, as an example. So you're still profiting. This is substitution. That means choosing this one instead of. All right, Daphne. Yes. I was not considering taxes. I was talking about substitution based on prices, but good one. There you go. Siding needs to be changed anyway. Thanks, Chad. Appreciate it. That was a better answer. So again, substitution right here tends to set the cost, be set by the cost of purchasing another equally desirable property. That means it's very similar to the one you're trying to buy, assuming no undue cost because of delay. So here's the example that I was just giving. If there's 2 similar houses that are for sale in an area, the less expensive house usually sells first. There are 2 similar houses. One is cheaper than the other. Then most likely the cheapest one will sell first. And this is the principle right here that I try to explain to everybody, to all realtors. Stop overpricing properties because of the market increase. The higher the price, the lesser the exposure. You guys understand? I always try to make it the lowest one. If it happens to sell for more than the original price, the original property, that means we created a movement. Now it becomes what's called a bidding war, right? Bidding war increases, yep, Chad just wrote, bidding war increases the effective value of a property because it's based on supply and demand. Got it? And it's something that sometimes can go backwards because I saw somebody on a bidding war, auction.com, so an old neighbor of mine, he was trying to buy the property where he lived, okay? And What happened was it was in short sale, and it was going through auction.com, and they created this bidding war. The property at the time, so I sold mine exactly the same as that one. I sold mine for 465, okay? And that was already difficult to appraise at the time. These people kept on bidding the property to up to 490 something. 490 something. So that's way above. Exactly the same structure as mine. It's just that my garage was on the right, his garage was on the left in terms of looking at the property. The only difference was the garage, right? Siding as well, a little bit difference. But they went on to bids to 492. Of course, when it came to, so he won the bid, right? But when it came to appraise for mortgage purposes, the property did not appraise, right? So sometimes it's good, sometimes it's bad. But creating a bidding war is great, and this is just a strategy that you guys can think of. A strategy you guys can think of for also creating leads, right? Because if you have more people seeing the property, what are the odds of those turning into leads for the next door neighbor that you're about to knock on the door and say, hey, I was able to sell this in 2 days. Are you willing to sell yours now? I got a list of buyers. Do you see what I'm saying? So the higher the price, the longer it stays on the market, the more difficult it is to sell. A lot of realtors disagree with me. We're in an up market. We're not in that kind of market. We can sell for whatever we want. True. But you still want to build leads, right? You want to prove to the neighborhood that you're the one that can sell and nobody else can. Because all the overpriced houses, they're still there. And yours, boom, out of the way. People come to your open houses. They want to see the property, right? Supply and demand, guys, we already talked about this, so I'm going to move forward. Conformity, we already talked about it. It's the fact that most properties in a particular block are very similar. As I just said to you guys, this particular property I was talking about the short sale, I sold that house. The guy had a house that was just like mine, just the garage opposite directions, right? But all the houses in that block were exactly the same structure. They were all two families, right? All of them had 3-bedroom, 2-bath in each unit. All of them had a garage. They're exactly the same architectural style, okay? And the majority of the people that lived there were in the same social and economic lines, okay? So that's conformity. The neighborhood is the neighborhood. Usually we don't have somebody that's a gazillionaire live in the low income area, right? Usually we don't have. Usually if it's a low income area, most likely low income people live there. Moderate income area, usually moderate income people live there, and so on. So it's conformity. It's not like you're being forced into it, but that's where people get used to. That's where you go. All right? And also makes it a lot easier to protect the maximum future value. Think about it. If each property is unique, then how do we evaluate it, right? So Yanessa was asking, so how do we figure out the value of a new construction? That was exactly the problem, right? If every house is unique, then there's no way to compare it. You guys got it? That's why conformity is essential. The next thing we have is regression and progression. Now, what does progress mean? What does progress mean? Forward, right? Improving, making it better, correct? So regress means what? Going backward. Backwards meaning you're losing, right? You're losing. You're lesser. So this principle is very, very important. Why? Because when properties are improving around you, if you don't do anything, that's great. Just keep up with the maintenance. Okay? If everybody else keeps improving, you just sit back and relax. Your house is going up in value regardless. So to prove a point, right, that's progress. To prove a point, here in Newark, there's a lot of old homes that are now worth $500,000. Why? because of all the new developments and dust, the desire and scarcity of the properties here. You got it? So they're worth $500,000 when just a couple of years ago they were worth 200 or 250. You guys understand? So your house went in value because everybody else's, the better homes, the newer homes, went up in value as well. They created value for you. All you did was maintain the value. Okay? As far as backwards, let's think about it this way. If you make your property better than anybody else's, because you have to be the king on the block. Perla, still frozen? Can you see? Okay, moving? Okay, great. Perla said that I had frozen on her screen. So, why are there $500,000? Because okay, so somebody asked me for properties in the Ironbound area of Newark. And they said, hey, my buyer is pre-approved for up to $350,000. I said right away, not in the Ironbound. In the Ironbound, even a single family will be 400s and up right now. In the Ironbound, if you're looking for two families as your buyer is pre-approved and that's what they want, you're looking at 600,000 or more. Why? Supply and demand. That's why, Perla. The property value went up because there's no inventory. People want to move to the Ironbound section of Newark, for instance, right? But there's no inventory. So they start asking whatever they want because of demand. All right? Now, when I was talking about regression is moving backwards. All right? Like a lot of you are doing right now, just walking around your houses and cars and stuff, right? So regression is going backwards. Why is this important? Because if you improve your property to $1 million property, you put like $1 million into it, right? Do you think it's worth $1 million? If you put $1 million into your home, is it worth $1 million? Okay, we got no. Daphne, I'll talk about that in a second. Not necessarily. So the best answer right now so far was from Gary. Not necessarily. So it could be yes, and it could be no. Here's the thing. You can put $1 million into your property, but if all the properties around are worth $250 and nobody else improves, guess how much your property is worth? Less than $1 million. Oh, but I put so much into it. It's a unique property. Look, it has this, it has that, it has a gold trim, right? Look, there's gold around. Like, that doesn't matter. You wasted money. We're going to talk about this in 3 instances about wasting money on a property. The fact that you improved your property to be better than anybody else's, right? It was mainly an ego thing, right? Your house is the best house on the block. Great, good for you. Doesn't mean it's worth more, all right? Or at least not much more. You guys got it? It's called regression, moving backwards. Any questions here? All right, I'm getting a lot of messages saying frozen or internet dropped. Oh, Flavio joined us. Didn't even see you before. What's up, Flavio? All right, Anthony, you're good? You reset your network. Okay, you're good. Sorry, I just saw your message now. Okay, David is gone. Got both Minas. All right, I think we're good. All right, so regression, progression. Any question about regression and progression? Yeah, Janice, all about the comps. Absolutely. Guys, any question regarding regression and progression? I'm lost. Supposed to be over before. Too long. I'm a little lost. Oh, the storm. Yeah. It was also supposed to snow sometime in December. These are the April showers, if you guys remember. April showers, May flowers, right? I guess we need to come up with a new rhyme for that. Oh, you Texas people. All right, Gil, can the house be not updated inside and still get great value with low demand? So traditionally, values have an upward trend. So regardless of what you do, if you haven't done much to your house and you own the house for the past 20, 30, 40 years, as an example, will it be worth more and you didn't do nothing to it? Yeah, because inflation, cost of things, new jobs. So we're going to talk about this, the geographic and demographics of properties, also of the towns. I'm sorry, also determine the value. So could you not update it inside and still get value with low demand? Yes. Traditionally, yes. Will you get a higher value if you improve? Then the answer is absolutely. You got it? So you don't have to improve your property. Like I said before, just maintain your property. Let everybody else improve their property. Make it way better. Right? So going back to what's here, that's why the least expensive property in the neighborhood is traditionally considered a good investment. You don't go for the highest price one, you go for the lowest and maintain it. Okay, but unfortunately there's people that have that thing, I have to have the best house, the best everything, right? Sure. For me, I have to have the best value. That's it. I gotta have the best car. Good for you, you're wasting money. For me, it needs to take me from point A to point B and hopefully not stop on the way. You see what I'm saying? Most millionaires and billionaires, they became that way because they knew about saving money. It's not about making money only, it's about saving money. The problem is most people start making money and they want to spend money, right? Here, I know you got a great house. Keep it, hold on to it, maintain it. Don't go overboard, okay? There's more to this. Perla says climate change. Well, that's not real. Okay? That's not real. All right. I'm being sarcastic. You don't have to say anything about that. Anyway, Gil, I'm a car nut, so I like everything else. Yep. Right, Geraldine made a comment. Stephen, thank you for helping her out. Hopefully it works. All right, anticipation. What is anticipation? Well, anticipation is you expecting something in the future. Simple. You anticipate something to happen. For instance, when you buy a multifamily income property, right? When you buy an income property, what do you expect? To collect rents over a certain period of time, right? Also, you guys remember right here, value of the house may be affected by rumors that an adjacent parcel is going to be converted to commercial use in the near future. Do you guys remember master plan? Okay. So there's no rumors about something changing. It will change because you don't go from residential to commercial just because somebody applied for it. If they applied for it, then it's now part of the master plan. Do you understand? So there's no rumors about it. We create the rumors because we know it's going to happen. And because it's going to happen, does our property increase in value? It could. It could increase in value if there's a demand for certain commercial properties in the area. Because if there's commercial, there's jobs. If there's jobs, better economy. If there's a better economy, everybody wants to come in, therefore higher values. Do you understand what I'm saying? So this was Master plan. That's why it's so important to have a master plan. Perla, so they built a new marina across the streets. Will that bring the value? So Perla, I mean, it was just a storm. You already got a new marina? That was quick. So yeah, it could increase the value, absolutely. Yep. And Gil, City Hall is where you get its future plan of growth. So City Hall, yes, building or zoning departments, or you can get it online as well. Most municipalities have it online. Okay. I still recommend, like I said, I still recommend to go to City Hall directly, just like Gil was saying. Go to City Hall directly and get to know everybody there. Next, we have increasing and diminishing returns. We already talked about this, where you improve your property so much that it's stopped being worth more is just an expense. So think about it this way. What is an investment? We're going to talk about this tomorrow as well, but what is an investment? Is putting something up front, could be time, could be money, right? Efforts, whatever. Putting something up front and expecting some type of return in the future, correct? That's an investment. So when we put, let's say, a brand new bathroom, that's the example that's come up in a second, a brand new bathroom, it might increase the value. So you put $15,000 as an example to build out a new bathroom. Supposedly it increases value, right? But if there's a lot of bathrooms already in the house, is it going to increase a lot of value? No, right? So there's something called law of increasing returns. That means whatever I put into the house gives me a higher value. Let's say it's a 3-bedroom, 1 bath, but I put a second bathroom there. The $15,000 is now worth $50,000 more. You see what I'm saying? So I had a nice return on my investment. But law of diminishing returns is when we look at a house that already has 3 bathrooms. Why would you put a 4th one? You spent $15,000 and maybe you increased $15,000. So it was a wash. You see what I'm saying? Okay? So there's increasing returns, there's diminishing returns. Contribution goes along the same lines. The value of any component of a property is not what it costs, but what its addition contributes to the value of the whole, or where its absence retracts from that value. So being there or not being there, does it increase or does it decrease value? For instance, the cost of installing an air conditioning system in an old building, right, may be higher cost than the return I'm going to get, which is based on the rentals, right? When I get an air conditioned building, central air, usually I can charge more, right? But how much more am I going to charge, right? And am I going to put a central AC in the whole building now and spend $100,000, let's say, into it, right? When am I going to get that return? Could I do something else with $100,000 and get a higher return? Those are the questions here. Or somebody who spends $15,000 on an in-ground pool may not add anything to the resale value of the house, right? So we look at, so this has been a great year so far in terms of heat, right? So yeah, pools are great now. But how long is it going to last? We're in New Jersey. How long does the summer really last? Or the ability to be in the pool, how long does that really last? See, we have a year-round maintenance of the pool, but we only have 2 months, maybe 3 months. And also, can you use the pool the whole time? Probably not. Look, we're in the middle of summer. It's raining like crazy. So probably not. So the whole 2-3 months might come down to 1 full month, right, of usability. And do we have the time in our great busy lives in Jersey, like everything's fast-paced, like New York? Do we have the time to actually enjoy the pool? Probably not. So maybe we're only going to use it like a week. So spending money and putting an in-ground pool, is that going to really add value to a house in New Jersey? You see what I'm saying? So I'm not saying yes and I'm saying no. It depends on the area and the type of pool. If it's a heated pool, Sure, we can use it year round. If it's an indoor pool, yeah, year round. You see what I'm saying? But most of the times, people are realizing, oh, it has a pool. No. I don't want this. Right? And then there's people that will buy the house because they want the pool, and then 2 months later they realize, wait, it's a big expense. It's higher taxes, right? I don't want the pool. And then they cover the pool or remove the pool altogether. You guys understand what I'm trying to say here? So putting money might not contribute to a higher value. Okay, you need to see and consider, is it worth it, the money I'm going to put into this property, okay? Oh, okay, Vanessa, so you got it. Okay, sorry. I didn't see this coming through. Stephen, how does increasing and diminishing returns apply to commercial buildings? The same thing. So, Stephen, it's exactly what we just went over here. Should I put an air conditioning system into this older building? How much more am I going to get? Is it worth it? Is it going to increase value? How much more value? So that's what we're talking about. Okay? All right? And then we have competition. This is mainly for businesses. Competition is, and not only for business, but for build outs. So it's not, we're not talking about residential purchase. Here we go into retail stores, for instance. That's the example. So businesses. Let's say we open up something here in Newark and we're the only ones here. We're making a lot of money. Guess what usually comes right after when people see that you're being successful at what you do? A similar business. So McDonald's opens, usually what opens right after? Burger King, Wendy's. So similar businesses open right after because of the success of one business. You guys understand? That's called competition. And that also goes into consideration when appraising, in this case, a business. How much competition do you have? It's going to be worth what you're asking for, right? So in Newark, there's a liquor store in every corner, as an example. There's a dollar store at every corner. There's a clothing store at every corner in the Ferry Street section of Newark. So are they worth more? No, because there's a lot of supply. You guys understand? There's a lot of supply. So therefore, the business values go down. Okay? Having a pool increases taxes. How if the value doesn't go up? No, it does. When you put the pool in, the assessed value goes up because now you have a pool. So it does go up in value. What I said is it worth the increase that you're gonna get? So let's say for resale, if you're trying to sell the property, you put $15,000 for an in-ground pool. Desirability is what determines the value. Okay? So do I desire a house with a pool, in-ground pool? Yes or no? If the average person says no, then that $15,000 is probably worth $15,000. So how much did it increase? $15,000. Was it worth it? No. That's what we were talking about here. Is it worth it? Is it going to make a big change? Should we invest this money? Okay, so we're talking about investments. Should we do this? Is it going to increase in value? Yes or no? And when we say increase in value, is bigger than the investment. Okay. All right. So 734. We're going to go into 3 approaches of value in a second. If we get through the first 2, I'm happy. If because the third one involves math and it's a little bit more detailed. So if that has to roll over till tomorrow, I'll be okay with, because I really want to make sure you guys pay attention. But we're going to try to do all 3 today if we can. If not, then it's totally okay. But I want at least the first 2, which is the sales comparison and the cost approach, to be covered today. So 7:35 right now, guys. 7:40, we'll be back. 5 minutes only, so run if you have to.